In this lecture, we're going to look at the valuation and accounting for the bonds payable, specifically using straight-line amortization and assuming issuance on interest date. So this is kind of like a review of information you have already covered in other classes, getting you ready for us to look at the effective interest rate method and what happens when issuance occurs between interest dates. So to start off with, there are really quite a few steps and a fair bit of red tape that is involved when you are entering into a bond issue. Uh, This is not something that is typically taken lightly by an organization. As we stated, they're looking for a significant amount of capital at the best cost they can pull off. So their cost is the interest that they will have to pay on these bonds and or any impact of a discount or premium would have on them. Uh, Issuance and the marketing of bonds. The time frame on this can be pretty substantial. It can take anywhere from just a couple of weeks to up to 6 months to go through the entire red tape process. Because there is a fair amount of time that can occur, there can be a resulting impact on the selling price of the bonds in comparison to the face value of them. The selling prices of bonds uh, all come down to a variety of factors, and this is the effective or the market interest rate, the economic conditions at the time in the investment market, the stated coupon rate of the bond in comparison to those market rates. Um, so when we're thinking about a bond issue, we start out knowing we're going to need an exceptional amount of capital. Um, and we know that we want specific terms. And then we said all of this in the beginning, and we start going through all that red tape as it's moving through underwriters and SEC approval, varieties of audits, issuing the prospectus, even having the bond certificates printed. The market is continuing to fluctuate. We are all aware that something can happen almost overnight in the market that can be significant. We have actually all lived through this in the 2008 and even a variety of other instances that have caused some type of significant market reaction over the years. What a bond will sell for in the market, because this is relatively free market conditions in the United States, is going to be a factor of a variety of things. One is the supply and demand of the buyers and sellers. This is the same type of concept of supply and demand that you covered in your economics classes. The risk that is associated with this specific issuer or type of bond. Because remember, there's different types of bonds. So bonds that are secured are less risky than ones that are unsecured. So that is one factor relative to risk. Another is the rating of the company itself. That's going to be a risk element that's going to impact the selling price of the bonds. Current general market conditions, such as interest rates for similar investments, and the overall state of the economy, which is what has a big impact on our market conditions. When the investment community is valuing, so this is the market. When they're looking at a bond, they value it at the present value of its expected future cash flows, which are going to consist of both interest and principal. So this is the semi-annual interest payments plus the present value of the face value of the principal. Bonds are issued with what is called the stated rate of interest, which is known as the coupon rate or the nominal rate. This is the fixed amount of interest for the term of the bond. It's written into the bond indenture. It will not change. They set this rate, the issuer does, when they're starting to establish their terms. Uh, this is what they will be paying in cash in semi-annual payments. This is going to be stated as a percentage of the bond face value, which is also called par. So when we move forward and we start saying whether or not they're selling at par or not, that just means at face value. When bonds are sold for more than their face value, it's called at premium. If they're sold at less than their face value, it's called at discount. The actual interest rate that is going to be earned by the bondholder in either of those situations is different from the stated rate. If the bond sells at face value or at par, uh, the the coupon rate is going to be the same rate that is actually earned by the bondholders. However, because of fluctuations in market conditions and the buying and selling of bonds, as well as the fluctuating in the credit risk of the organization, this may not actually be the case. The amount of interest or the rate that is actually earned by the bondholders as a result of our free market expectations. And this is going to fluctuate based on periods of time and a variety of other factors, such as the general state of the economy. This amount um, is what the bondholder is actually going to be receiving as a result of their transaction. When there is a difference between the coupon stated rate and the market rate, the selling price of the bonds will change from their face value. Terms of the bond, when they were originally written to the point in which they're actually issued, can be more desirable or less desirable on the market, depending on any variety of factors, including current interest rates. The difference between those market expectations and the face value defines whether the bond is selling at discount or less than face value, or if it's selling at premium, which is more than face value. Now, the calculation of interest, this is how much that's actually paid to the bondholder each period. So these are the checks in a given period that will be issued to the bondholders of record. So we take our stated rate and we multiply that by the face value of the bond. This is the amount of cash that we'll be leaving. However, the amount of actual interest that we would record as an interest expense is the market rate times the carrying value of the bonds. We'll get into that more deeply here in a later lecture. This again is more of a reminder of a lot of information you know. We're adding a little bit of tidbits in here that we need to reinforce for a variety of reasons, up to and including it may be covered on a CPA or CMA exam in the future. When we issue the bonds and we create the stated or the coupon rate, this is the amount of interest that is actually paid to the bondholders each period. Ideally, it's going to be the exact rate at issue. But again, that's a very ideal circumstance. That's not actually what always happens. And bearing that in mind, because the market does fluctuate, we end up with variations. And these variations have different impacts on the proceeds we would receive from these bonds. Uh, so we're going to say that there's a stated or coupon rate of 8%. Now, if the market interest rate at that exact point in time is 6%, that means that similar interests or similar issues are paying at 6%. That's the expectation of the market. Then the bonds are going to sell at that point for premium. Uh, and the difference in the amount, so they're going to sell for more than face value, and the difference between Face value and the proceeds that are received will be posted into account that is an adjunct account, and it's called premium on bonds payable. If by chance things work out right and the market interest rate is at 8%, which is the same as the stated or coupon rate, then they're going to sell at par value. So we're going to have no variance between proceeds and our obligation at maturity. However, if the market interest rate is higher, say 10%, and our coupon rate is 8%, uh, then we will be paying less than similar issues at those semi-annual interest payments. In that case, our bond is going to pay a discount or less than face value. And the difference between the face value and the discount will post the difference between the proceeds, because we'll receive less than face value, and face value, we will recognize in an account called discount on bonds payable. And this is a contra account. Now, these differences, whether they are premiums or discounts, meaning we received more in proceeds or less in proceeds than face value at issue, is amortized over the term of the bond. This period would be used even if there is a callable provision attached to the bond, because call redemption is really uncertain. It is there often in the benefit of the corporation so that they can take advantage of falling interest rates if they occur. Um, that is just one of the really good, perks of having a callable provision on your bonds for the corporation. Now, this amortization and this process of allocating either the premium or the discount over the life of the bond can occur in one of two ways. We can use either the straight line method or the effective interest method. Here in this specific lecture, we're going to demonstrate the straight line method. The effective interest will be demonstrated in its own separate lecture. There's a couple of things that you really do need to know and you need to keep in mind. You can only use the straight line if the difference between it and the effective interest method is not material. Straight line amortization should not be used when the term is very long and there's more than a minor difference between the market and the coupon rate. Um, and it should not be used if there is a substantially significant difference between the market and the coupon rate, regardless of term length. Ultimately, what is going to happen through amortization, whether we're using straight line or effective interest rate, is that the book value of our bonds payable will end up equaling the face value of our bonds on maturity date. Remember, this is the amount that is going to be paid out in order to retire the bonds. When we utilize the straight line method, as we're going to look at here over the next several slides, what we are doing is we're recognizing a constant amount of amortization each period over the term of the bond. Straight line amortization, whether we're using it for intangibles or we're using straight line depreciation for fixed assets, and then straight line amortization of bonds, premium, or discount, all are going to be a constant rates. So when you hear straight line, you just know it's going to be the same amount. To start off with, let's look here at Service Master. And with Service Master, they're issuing $100,000 in bonds due in 5 years with a 9% interest payable annually at year end. Now, at the time of the issue, the market rate for similar bonds is 11%. We are paying less than the current market rate. If we are paying less than the current market rate, then our bonds are going to uh, be issued at a discount. So the first thing we have to do is we have to calculate how this is going to work. So let's show you that because we're going to use the present value. And we're looking at the present value of an ordinary annuity with periods of 5. And we use the current market rate, so that is 11%, because that is the expectation of the investing public. So let's start with the present value of the principal because we have these two different aspects, right? We have the regular semi-annual interest payments that will occur, and then we have the lump sum payment at the end. So starting with the present value of the principal, we calculate that, and it's table 6.2 in your book. So you will have to go back or access the present value tables. So we're looking at the present value of a fixed amount. So the present value of $100,000 after 5 years is $59,345. We then do the present value of an ordinary annuity, and we do that using the time period of 5. Knowing what this breaks down to in present value will be $33,263.10. So our current present value, or the selling price of the bonds, is going to be $92,608.10. Now, this is a $100,000 bond issue. So there is a variance currently um, between what we will recognize as our bond payable, because we will recognize that at $100,000, because when we enter into the issue, that is our obligation. We credit to bonds payable the face amount of the bonds issue, regardless of what the proceeds received were. Now we are going to only receive $92,608.10. That gives us a difference of $7,391.90. Now, that is going to result in us having a discount on our bonds premium. So, the first thing we're going to do is we're going to look at bonds that are actually issued at par, and this means that they are issued at their face value. So there's no discount, no premium that's in effect. And these are being issued on the interest date. Again, we are going to be looking at this so that we don't have to take into account to begin with any interest accruals. We'll look at that separately. But first, we're going to start here with at par on the interest date. Now, the interest date is every 6 months, semi-annually, January 1st and July 1st. So when we issue on January 1st, there's a full 6 months before we enter for our July 1st. These are 10-year term bonds. They have a par value, which means their face value, or the amount of our obligation at maturity is going to be $800,000. We're issuing on January 1st, 2017. And there is an annual rate of 10% payable semi-annually. You always want to take into account those things like semi-annual or quarterly, because that's going to help you break apart everything. So to start with, at issue, so when we actually receive our bond proceeds, these are being issued at par value. So that means that we will receive cash of 800,000, and we will recognize our obligation of 800,000 on this day. Now, when we have bonds that are issued at par on the interest date, we're going to have our regular semi-annual interest payments and our interest accruals. The first thing that happens is that on July 1st, 2017, we're going to have to make our first payment. Now, the first semi-annual interest payment is going to be 800,000 multiplied by 10% divided by 2, or 40,000. Uh, we will pay that amount out in 40,000. So 800,000 multiplied by 10% multiplied by half, or divided by 2, um, shows how much we will pay out every 6 months. Now, on December 31st, 2017, we've not actually reached the second payment date yet. That'll be on January 1st, but we have fulfilled that full period of time. And we are at the end of a fiscal year. Because we are at the end of a fiscal year, we need to recognize the appropriate expenses that apply to this period of time and accrue the interest accordingly. So our cost of borrowing through December 31st, 2017 is also 40,000. This is our interest expense. This is the other half. And then we will have interest payable of $40,000. Now, at the point that this is paid out on January 1st, we would then debit our interest payable $40,000 and we would credit our cash $40,000. Now, we do know that the whole selling at face value, selling at par is not something that is guaranteed. So one of the things that I want you to really take into account is that we really start have to looking at those, discounts and premiums. We're starting with the interest date again, so that there's no interest accrual impacts. Most of this you have been exposed to already in prior classes. However, it is kind of important that you understand how it works and you really get a good solid grasp on it before we start playing with the accruals and the effective interest rate method. So we're going to re-cement all these concepts. So in this case, the bonds are issued at discount on the interest date. This means that the market rate is currently greater than the coupon rate, and they are sold at 97. So this 97 is going to represent the percentage of par that we can expect in proceeds. So they issued 800,000 of bonds on January 1st, 2017 at 97%. There is a bearing interest at an annual rate of 10% payable semi-annually. So everything else about these bonds is the same, just changed in regards to the stated or coupon rate to market rate. So we received cash of $776,000. We currently will have an obligation of $100,000. That leaves us with a difference of $24,000. Remember, these were sold at a discount, which means they sold less than their face value. So we will recognize in the discount on bonds payable $24,000. We recognize in our bonds payable account the full value of $800,000. Just remember discounts as amortized over the term of the bond um, are then posted as additional interest expense and at the interest dates and the accrual dates. So to kind of uh, illustrate this, we will work forward and we will look at the first semi-annual payment and how the bond discount will be dealt with. We'll be using a straight line method. Remember, you can only use straight line in certain circumstances, and basically it comes down to whether or not the difference between straight line and effective is material or not. If it's not material, you can use the straight line method. Otherwise, you have to use the effective interest rate method, and we'll go over that in a separate lecture. But assuming that we are going to use that, 1,200 of that discount is going to be amortized to the interest expense for each period for 20 periods. So this is how we would do this. We would start with our first period. This is our first semi-annual interest payment and bond discount amortization. It's going to occur at the same time. So we had $40,000 of interest, if you'll recall. However, we have an additional $1,200 that we need to recognize in interest expense as the result of proceeds not received from the original issuance. We will reduce our discount on bonds payable by $1,200 and we'll pay out the $40,000 in cash as expected. Remember, we're using straight lines, so things aren't going to change. Your coupon rate is not going to change. Your face value rate is not going to change. So on December 31st, 2017, when we recognize our interest accrual, we'll recognize an interest expense of $41,200. We'll have our discount on bonds payable reducing by $1,200, and then we will have our interest payable of $40,000. On January 1st, 2017, when we pay out that interest in the form of checks to our bondholders, we will debit interest payable $40,000 and we will credit our cash $40,000. Now, the last situation that it can occur, because you can sell it at par or face value, or you can sell it at discount or less than face value, or you can sell it at premium. And again, we're still using the interest date. And here we sold it at 103. This means 103%. So when we take $800,000 and we multiply that by 103% or 1.03, we will have cash proceeds of $824,000. Our obligation is only $800,000. So we have a premium on bonds payable of $24,000 and a bonds payable of $800,000. Now we're going to utilize the straight line method of amortization at $1,200 over 20 periods when we work on the amortization in the next slide. When we sell at a premium, this means that our coupon rate, the amount that we are paying semi-annually, is greater than the market rate. When we engage in the amortization of the premium, it will post to our interest expense and it's going to result in an overall decrease to our interest. So on July 1st, when we encounter the first semi-annual interest payment, we will only recognize $38,800 worth of interest. We will reduce our premium on bonds payable by the straight line amount of $1,200, and we will still pay out in cash the expected $40,000. This same entry will occur on December 31st, 2017, when we accrue our year-end amounts. Now, the reason why these entries are absolutely identical for payment and for accrual is because when we enter into the interest periods, they're falling exactly at that calendar point. This is not always the case. Usually there's some type of a between interest, or we only have 4 months of interest at the end of the year. So always keep in mind what is the real fractional period as you're doing a year-end entry. This is actually going to wrap up this specific lecture. We'll look at bonds that are issued between the interest dates next. And that will begin the next lecture. And then we will also look at, in that one, the effective interest method. So the next lecture will be we'll be taking this basic information that you have already been exposed to, and we'll be tweaking it and applying it more to real life scenarios. Straight line, again, is an amortization method. It's either going to increase our expense or decrease our expense at a set amount over regular interval periods of time over the term of the bond. Can only be used if the difference between it and the effective interest rate method are considered immaterial. So the difference is not really going to impact anybody's decision making. Um, One of the things that's important to keep in mind is that by and large, typically there's not a huge difference, and the straight line method is actually often used. But you will, for your homework exam and for the CPA exam, have to have awareness of both the straight line method and the effective interest amortization method. So when we move into that, pay very special attention. The straight line method should be relatively easy for you to understand. It should also be relatively easy for you to calculate because it is so similar to those other straight line methods that we use in regards to the amortization or the depreciation of assets. We will break here and then we will come back in looking at building on the information that you already know um, that we have shored up in this lecture in the last, and go on to look at uh, above and beyond that, the higher concepts. Have a wonderful day, and I will see you in the next lecture.